All right. Now, in the market, you have two participants. Two participants majorly you have in the market. You have the bulls and you have the bears. The bulls are those who are pushing the market to the upside. They are looking for buying opportunities. They are buying, they are pushing, their pending order is supposed to be buying. So they are buying the market. They are just buying the market, buying to the market. Now, the bears are the opposite. Those ones are looking to sell the market. They are looking to short the market. In the forex market, you are either buying or selling. And so in this training, the essence of this training is therefore to let you know when to buy and when to sell. The buyers are called the bulls, while the sellers are called the bears. Okay, so in the market, and let me tell you something. Every single moment in the market, somebody is buying, another person is selling at the same time. Every single time in the market, there are buyers and there are sellers at the same time. But when the market is buying, what it means is that there are more buyers than sellers. At that particular time in the market, there are more buyers than sellers. So the market is buying, the market is going to the upside. The opposite is also true. When the market is selling, at that time too, there are also buyers. But what it connotes is that there are more sellers than buyers in the market. There are more sellers than buyers in the market. So the market will be bearish. And the word bulls and bear are selectively chosen from the names of animals. The bulls is the male cow, and you know how the bulls fight. The bulls fight using the horn to push its prey from down up. It pushes its prey from down up. The bears, operate opposite. It uses the claw, the hands to press the prey, the prey down to the ground. It pins the prey to the ground, and that's how they came about the terms bulls and bear. The bulls are the buyers. The bulls are those who are pushing the market to the upside. The bears are the sellers. They are pushing the market downward. They are pushing the market down. And you can see an example on my screen here. Look at the horn of the bulls. When it wants to attack the prey, it took it down and pushed the prey upside. It pushes the prey to the upside. And then the opposite is true for the bear. The bears, uses its head to attack the prey and pins the prey to the downside. And so what we are saying is this. So when you see the market like this, that is moving up and up and up and up and up like this in this direction, it is said to be bullish. The market is said to be in an uptrend. So a bullish market is an uptrend market. It's a market that is going to the upside. It's a market that is going to the upside. So this is how it looks like. So it's forming a high and a low, 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 a high and a low. And so, and every new high you see is higher than the previous high. Every new high you see is higher than the previous high. Every new high you are seeing is higher than the previous high. Every new high you are seeing is higher than the previous high. So when the market is forming a series of higher highs and higher low, it is said to be in an uptrend. So the market is said to be bullish. When the market is forming a series of higher highs and higher low, it's an uptrend market. So it's a bullish market. So what do you do in that kind of market? You'll be looking for the opportunities to buy. You're going to be looking for the opportunities to buy. And the opposite is also true, okay? Look at it like this. So you enter a long position. The opposite is also true when the market is forming, high and high and high and high, and each high you are seeing is higher than the previous high. Each high you are seeing is lower than the previous high. So when the market is forming lower highs and lower highs and lower high and lower high, it is said to be in a downtrend. Look at what we are talking about. This is a low. This next low is lower than the previous low. This low is lower than this low. This low is lower than this low. So when market is forming a series of lower highs and lower low, it is said to be in an uptrend. Like I explained this one now. Look at every new high you see is higher than the previous high, and every new low you are seeing is higher than the previous low. So the market is forming a series of higher highs and higher lows, higher highs and higher low. When you see something like this, when you see market forming a series of higher highs and higher low, it is said to be in an uptrend. Therefore, you're going to be concentrating on looking for opportunities to buy. You'll be concentrating on looking for opportunities to buy. Then you see lower highs and lower lows, lower highs and lower lows, lower highs and lower low, 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 lower highs and lower low. So when you begin to see something like this, the market is said to be in a downtrend. So market is forming series of lower highs and lower low. It is said to be in a downtrend. It's a bearish market. It's a bearish market. It's a downtrend market. The market is selling. We are saying the same thing. And therefore, in this kind of market, I'll be looking for the opportunity to sell. How to join the sell, that is for another day lesson, but I'm establishing the kind of trends that are tradable in the market, the kind of trend that are tradable in the market. Actually, there are three tradable market patterns. These are what we call market pattern: the uptrend, the downtrend. So look at the diagram on my screen here. You can see the market is forming high, then we have a higher high, then we have a higher high, then we have low, then we have a higher low, then we have the higher low, then we have the higher low. And when the market is forming a series of higher highs and higher lows, it is said to be in an uptrend. Then when forming is, so this is low, this is high, we have a lower highs and then the lower low, a lower highs and lower lows. When each low is lower than the previous low, the market is said to be bearish, is a downtrend market. Now, the third category of market pattern is what we call the ranging market or the sideways market. The ranging market or the sideways market, when the market is moving between a fixed position, a fixed resistance and support, a fixed resistance and a fixed support, it is said to be a ranging market. So market is in a ranging, market is ranging. It is not up, it is not down, it is just going to the side, just going to the right side. So it's called a sideways market. This is what we're going to be focusing on. This is the foundation of technical analysis, is the foundation of technical analysis. There are three ways to analyze the market. And one of them is the technical analysis. We have the aside technical analysis, we have the fundamental analysis. Fundamental analysis. This is when we use the economic data, the news that you see, the release of economic data. You know, I use it to make decision in entry and exit in the market. You are using fundamental analysis. But when you sit behind your screen, you are using your candlestick patterns, candlestick formation to determine your entry and exit, then you are using technical analysis. And usually the combination of both is great. It's usually good when you have an understanding of the fundamental analysis and technical analysis and you're able to maximize it. And that's what we're going to be focusing on in the course of our study. So we have the uptrend market where you'll be looking for opportunity to buy. We have the downtrend market where you'll be looking for opportunity to sell. Then in a ranging market, when you have a fixed resistance and a fixed support, and the market is ranging between the fixed resistance and fixed support, what do? You'll be looking to sell at resistance and to buy at support. You'll be looking to sell at resistance and then to buy at support. Let me quickly take it to the chart so that you can see a practical example. Here. Now look at my screen now. You can see that the market is forming you can see that this is an uptrend market. This is an uptrend market. This is an uptrend market. Oh, no. Sorry, bear with me. I'm trying to check one of these. what is happening to so you can see that the market is moving to the upside like this. Market is moving to the upside. So in this kind of situation now, the market is in an uptrend. And how do you know the market is an uptrend? Look at this now. Look at here. This is the market is forming. Look at it here now. A high here. You can see. Let me use letter. You can see high. Okay. Let me use something like this. Let me use something like this. You can see market going like this. Then it comes like this. Then it comes like this. Then it goes like this. It's forming. Then like this. Market is forming like this. Then it's coming like this. Then it's going like this. Then it's going like this again. You can see how the market is moving. So it's forming high, low, high, low, high, low. So when it's forming series of higher highs and higher lows, it is said to be in an uptrend. Look at this. You can also have this one here. Then you have it here. Okay. Okay, so how do we label it now? You have high or higher high. You have higher high here. You have higher high. Then you have higher low. Sorry, you have higher high. Then you have higher low. Then you have higher high. Then you have higher low. So you have higher high, higher low, higher high, higher low. So when the market is forming series of higher highs and higher low, you discover that market does not move on a straight line. The market doesn't move like this. Market does not move like one straight line like that. No, market doesn't move like that. Market moves higher highs and higher lows. So what do you now? I want you to notice something. You discover that the longer side is toward the direction of the market. The longer side, look at it, this one is longer than this one. This one is longer than this one. The market is usually to the direction of the longer side. To the direction of the longer side. You see that where the market is forming the longer side is the direction of the market. That is where you should be looking to buy the market. So now let me really give you a label. You know, so see here now. Here we call this one impulsive movement. We call it impulsive movement. Impulsive movement. You have impulsive movement. The longer side is called impulsive movement. This place is called impulsive movement. Okay, as in here now, here is called impulsive movement. Okay, then we have impulsive movement to this side. Then we have this place. We have this place now. This particular place here is called the pullback. Okay, it's called the pullback. The pullback. It's called the pullback, or it is also called retracement. It's called retracement. It's called retracement or it's called correction. Okay, so you'll be having impulsive movement, pullback, impulsive movement, pullback, impulsive movement, pullback, impulsive movement, pullback. That's how market moves. So now you discover that you should be looking for the skill to, how does a professional trader trade? How does a professional trader trade? He entered at the beginning of an impulsive movement and comes out before the end of it. He entered at the beginning of an impulsive movement and comes out before the end of it. He entered at the beginning of an impulsive movement and comes out before the end of it. At the beginning of an impulsive movement, comes out before the end of it. That is how a a professional trader trades, especially a day trader. Especially a day trader. A swing trader is a different thing. Don't worry, all of that I'll be explaining to you. What I'm trying to establish today is the market patterns. Market pattern. Let me go to GBP USD. Let me go to GBP USD. GBP USD. Oh, fuck. GBP USD. Why this thing is rolling like this? What kind of network is this? GBP USD looks like this. Now, okay, you can see from this distance, the market has started selling. Market has started selling. So you can see, how do you do it now? You can see market like this, moving down to this place, then moving up, pullback. Then we have impulsive movement, we have a pullback. Then we have impulsive movement, you have a pullback. Then we have impulsive movement, then we have a pullback. Then we have impulsive movement. You can see that's how market moves. That's how market moves. Market does not move on a straight line. Market doesn't move on a straight line like this. Market does not move like this. No, market does not move like that. Market moves, it takes a movement, then you rest a little. It takes a movement, then to rest a little. Take a movement, then you say retracement, a pullback or retracement. Impulsive movement, a pullback, retracement. You can see this is how market operates. And this market is a bearish market. So we have something like we have what we call the I, the I, the higher lows, okay, the lower highs and lower lows. So we have lower highs, we have lower lows, we have lower highs, we have lower lows, we have lower highs, then we have lower lows. We have it like that. Okay, so this is how market moves. This is how the market moves. This is how the market operates. We have the lower highs, and we have the lower lows and lower highs and lower lows. We have the lower lows, and we have the lower lows, and then we have the lower highs. We have the lower highs, like that, like that, like that. You see, these are the market operates. So this is the downtrend. In this kind of market now, you should be looking for opportunity to join the sell, opportunity to sell, opportunity to join the sell. So now let's see if we can find an example of a ranging market, a ranging market, a ranging market. Let's see if we can find a ranging market somewhere, a ranging market somewhere. Ranging market where the market is just giving you is not up, is not down, is just ranging, it's just moving from left to right. The market is just moving from left to right. Market is not ranging. Market is not buying, it's not selling, it's not bullish, it's not bearish, but it's just ranging. It's just moving between a fixed resistance and a fixed support. So if you look at this market now, if I draw this line here and then I draw the line again here. Okay, you will see that within this time frame, within this zone now, market is not really making any progress. When it gets to the support, it goes up and hit this resistance, then comes down, hit resistance again, come down, hit resistance again, come down. So in this kind of market now, you are looking to buy at this support and to sell at this resistance, to buy at the support and to sell at resistance. So this is what we call ranging market. Ranging market. A ranging market. So when the market, or you can call it a sideway market. A sideway market. These are the three trade. In fact, all their technical analysis we're going to be doing henceforth. All the technical analysis that we're going to be doing henceforth will be based on how to buy, how to take advantage of this market trend, whether bullish market or bearish market or a ranging market. This is what we are going to be spending so much time learning henceforth. Okay, so you can see a ranging market also here now. You can see a ranging market here. You see that within this zone, market is not making progress to the upside, it's not making progress to the downside. It's just between a fixed resistance and a fixed support. So when the market is moving between a fixed resistance, you can see now when the price get to this place, it's coming down, hit here again, coming down, hit here again, coming down. The market is ranging for a while. It's ranging for a while, and then in that instance, it requires a different strategy to trade a trending market. A different strategy to trade a trending market. When the market is, when the market is ranging, it requires a different approach, to trade it successfully. So you see now, market is higher, high, higher, low, higher, higher, low, and all of a sudden it start to range. So market spends sometimes, trending. Then after some time, it will range for a while. Then it will continue to trend again. That is how financial market operate. Other financial market operate. So these are the three tradable market that I want you to focus on: the uptrend, the downtrend, and the ranging market. So I need you to I give you some example yesterday of exotic pairs. On the exotic pair, GBP USD, Euro USD, sorry, major pairs. Let me see if I can show them to you on the chart again. You look at this major pair and give me, on each of the major pair, you give me two examples each of a bullish market, bearish market, and ranging market. Look at this on my screen now. On Euro USD, two examples of bullish market, two examples of bearish market, two examples of ranging market. Then you go to USD JPY, you find you give me two examples of bullish market, two examples of bearish market, two examples of ranging market. You will mark it out. You will put an arrow. You will label higher high and higher low, lower high and lower low. Then you will draw a box that covers a period of the market. That market is ranging. Then GBP USD, AUD USD, NZD USD, USD CHF, and USD CAD. That's the example tonight